Berkshire Hathaway has been increasing its stake or purchasing companies lately. In 2022, it bought 15% stake in Occidental Petroleum in $5 billion. It also acquired insurance company Allegheny in $12 billion. And most importantly, after exiting IBM, it has purchased 11.2% stake in a technology giant. Well, I'm not talking about Apple here. Apple is pretty much considered a consumer company, and everybody knows about it. That Berkshire Hathaway has been buying Apple since 2016. Yes, it has actually purchased Hewlett Packard, HP Inc. You heard that right. Berkshire Hathaway has purchased 11.4% stake in HP Inc. last year in April in $4.3 billion. This year, it actually increased its stake by 16% to 12.4%. And right now, HP Inc. is within the top 10 holding of Berkshire Hathaway. To be precise, is the 9th top holding of Berkshire Hathaway. Hello everybody, and once again welcome to Synonomics, the money machine. By now you have understood I'm going to talk about HP Inc., Hewlett Packard. The ticker symbol is HPQ. Well, HP's capital allocation as a favorable way to increase its investment story is actually compelling to a company like Berkshire Hathaway. Under the new CEO, Enrique Lors, HP actually announced a whopping $15 billion stock buyback in 2020. The company has already completed $13 billion worth of stock buyback, share buyback by January this year, by January 2023. And they will complete the rest soon. I personally feel that HP Inc. will continue its share buyback program even after that. Meanwhile, in 2022, last year, October timeframe, HP also announced its purchase of Poly, the workspace tech seller. Earlier it was known as Plantronics. Yes, HP has bought Plantronics, or Poly as it's called now, in $3.3 billion to increase or strengthen its position in the hybrid work environment. And Buffett has long liked when the companies increase their competitive moat. I see Berkshire's ownership of HP Inc. as a validation of HP's strategy and its capital allocation. Well, that said, HP didn't have a very smooth sailing lately. In the last quarter, Q2 earnings, HP did announce that the HP printer sale has fallen by 5%. Consumer PC is down by 36% and commercial down by 18% from the last year's number. So pretty much the post-COVID PC hangover persists, guys. And not only that, for other companies as well, the competition, we are seeing very tepid growth. Having said that, it's kind of picking up now. Even earnings declined by almost 32% year over year for HPQ. That said, HP is trying to work hard to bring the business back on track, especially in the PC shipment area and the market share area. In November 2022, the tech giant actually revealed a $1.4 billion worth of cost-cutting plan, and that includes the headcount reduction of 4,000 to 6,000 by 2025. Well, despite all those, HP shares have fallen by 20% in the last 1 year. That said, let's look at what is HP doing right, which makes it attractive from the investment philosophy perspective. HP is quite attractive for the value investors. Let's look at that, guys. HP is doing a lot of things right to bring the business back on track. Number one, it actually launched the cost-effective subscription model for its print business. It also bought Samsung's printing business in $1.05 billion. HP also bought office supplier Apogee to kind of tap on the $55 billion A3 copier market and the managed print services. HP also acquired HyperX, which is a gaming peripheral division of Instant Technology, in something like $425 million. So these are the gaming mouse, gaming keyboard, gaming headset, etc. All the gaming peripherals to strengthen its gaming portfolio. It's also working very hard, and some of its gaming platforms actually come with AI chipset of NVIDIA. And recently, the CEO announced that it's working very closely in the AI space, which also NVIDIA announced recently that they're working to kind of bring the AI, artificial intelligence, more in the PC and the workstation space. So HP Inc. is also pretty much working hard to bring AI and generative AI into the desktop, PC, laptop and gaming platforms form factor. Well, as I also mentioned earlier, it has purchased Poly, earlier known as Plantronics, in $3.3 billion, and that will further strengthen its position in the hybrid work environment. So a lot of things actually HP is doing right, but we'll go deeper and see from the finance perspective how the balance sheet looks like. What's the P&L looking like? So well, from the market cap perspective, it has a $30 billion market cap. It just closed on Friday at $30.5, $30.50 or so. Its revenue is $56 billion, guys. So with a market cap of $30 billion, revenue of $56 billion, the price to sale ratio is pretty much sitting at 0.54. Yes, you heard that right. The PS ratio is at 0.5. When we talk about the price earning ratio, as of Friday's price, it's trading at 11.7 times. And if you look at the forward 2027 earning perspective, the forward price earning ratio is almost 7.4. Its 5-year average PE ratio is 7.6. Yes, you heard that right, guys. It's trading at 7.6, 7.4 price earning ratio as compared to 18 to 19 price earning ratio of S&P 500. Well, even from the free cash flow perspective, it actually this year reported 2.26 billion cash flow, free cash flow. And that was impacted, of course, by the Poly and other acquisitions. If you look at the 5-year average, the cash flow is at $3.9 billion, roughly $4 billion. ROIC, return on invested capital, last year was 56%. This year's number is slightly lower. Actually, it's much lower because of the acquisition I talked about. And that's where I personally feel that to a tech company, to a technology company, you cannot really value them based on the return on invested capital, because it depends on their acquisition, and this is the classic example of that. Well, from the dividend yield perspective, you'll be surprised to know HP actually offers 3.5% dividend yield. Yes, and also this dividend policy is very healthy. When I say healthy, it's much below the 50% of the free cash flow. The total dividend it has given is $1.02 billion. That is way below its $2.26 billion free cash flow this year. And if you look at the 5-year average cash flow, it's 4%. So the dividend is pretty much 25% of the 5-year average free cash flow, which will be considered very healthy from finance perspective. Well, if you look at the cash in the books, cash and cash equivalents, right now it's pretty much at $2 billion. Last year it was $3.2 billion. Needless to say, all these purchase of poly, etc., has impacted it. So it's pretty much a cash-rich, dividend-yielding company. And let's look at the other important aspect of HP Inc. Yes, I am talking about share buyback. I did cover that in 2020, Enrique Lors announced $15 billion of share buyback. Not only that, it has been purchasing this for last multi-years. As of April this year, the total outstanding shares of HP Inc. has been $0.99 billion. Oh, sorry, $0.99 billion. Not dollar, my fault. Well, if you look at the previous ones, it has actually drastically reduced its shares, outstanding shares. In 2017, HP Inc. had 1.73 billion shares on issue. And as I mentioned, this year, it's right now sitting at 0.99 billion. So guys, it has almost reduced 43% of its outstanding shares in the last 5.5 years. Though the revenue outlook is pretty much flat right now, unless we see an uptake in the PC market. The revenue outlook is from $56 billion last year to something like $58-59 billion in 2027. So I would consider it's pretty flat. But having said that, the company has been buying its cheap shares. Yes, these are the cheap shares, and when the company purchases or repurchases cheap shares, it's considered very good. Cheap from the price earning perspective, I just talked about it, 7.4 versus 18 price earning ratio of S&P. It's dirt cheap, guys. And HP Inc. has been repurchasing its stock. It's paying 3.5% dividend. And last but not the least, it's still growing. The EPS, which was $3.39 is supposed to grow to almost $4.14 by 2027. So it's buying the cheap shares, it's giving the dividend, and at the same time, it's growing its earnings. What else you want? It's not a sexy company like Nvidia and Tesla, etc., but it's a consistent compounder. It's a cash machine. It's actually a money machine. JP Morgan's analyst Samik Chatterjee calls HP's valuation as undemanding in light of the positive sales catalyst in the long term. He believes that the near-term headwinds are quite material, but in the long term, he believes that HP will be able to maintain its market share and maintain the growth in the PC business because of its large install base of the post-pandemic. And very soon, HP Inc. will be pretty much in the pre-pandemic stage, where it will be having a good market share and you'll see the growth in the business, which we are hoping to see that very soon as the market is picking up. Well, with that, if you don't have HP Inc. in your portfolio, probably it's time to think. If you are a value investor like Warren Buffett, you will or you should consider HP Inc. in your portfolio. As I talked about it, it's a high dividend yield company. It does the share buyback and it's still growing its earnings. Having said that, guys, these are my personal opinion. Don't forget to consult your finance advisor before making any investment decisions. Sinhanomics is out there to create financial awareness, give you some exciting insights of these market leaders in the technology space so that you can analyze your companies, make your own decisions, and make money. With that, if you like this kind of contents, don't forget to like, share, and subscribe. I'll come back again with interesting insight of another company. Till then, it's a bye from your finance coach, Pankaj Sinha. Bye-bye.